tequila shots. You've never known when you've had enough until you've had too much. And government debt tends to be the same story. You feel good, and then at some point you're throwing up in the bathroom. So yeah, your point is, when do we start throwing up in the bathroom? And the answer is, I'm not quite sure, but I know it's not a great asset class to own, because at this pace, it's like you're seeing the guy at the bar just pounding the tequila shots, and there's nothing good coming out of that. You're not quite sure when he's going to hit the wall, but that wall is there.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting, as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunne.
Thanks for the introduction, Niels. Today, I'm delighted to be joined by Louis Gave. Louis has been on the podcast a couple of times before, so it needs no introduction. But for those who haven't heard from Louis before, he's the founding partner and chief executive officer at Gave. He's been in the markets many years and the author of several books. Louis, great to have you on. How is all on your side?
Things are good. I'm delighted to be back. Thanks for inviting me.
Not at all, no. And as I said, you were on, I think it was October last year and the summer the previous year. So if people want to sense check how your views have evolved or hear your full backstory, they can listen to those episodes. But
hope I didn't say anything too embarrassing back then. I can't remember what I said.
Well,
hopefully it stood the test of time.
I had a quick look back. It is funny how you kind of forget what was topical at the time. But you did, I mean, to your credit, you had a couple of very good calls. You were pretty confident. You were confident that Trump would win. And so you and, was it the French guy you had the big bet on the betting markets?
Yeah, that's right. The French whale. A lot of people asked me if that was me, and it wasn't. Just to be very clear, that was not me. But I had quite a number of clients ping me and saying, "Hey, dude, what are you doing putting out such big numbers on the U.S. presidential election?"
Well, you seemed equally confident at the time, and you were right on that. And the other point, the last couple of times you've been on, you've been definitely in the no recession camp on the view that such large deficits in the U.S. are not normally associated with recessions. And obviously, the deficits have not got any smaller in the last couple of years, so they've been getting bigger. But we have had some weak data out recently, which have kind of reignited calls for maybe a possible imminent downturn. So maybe that's a good starting point. How are you reading the data? Do you see increased concerns on that front?
Yeah, look, I am increasingly concerned. I became a lot more concerned when with the tariffs back in April when these were announced. And both Anatol, my business partner, Anatol Kaletsky, the Cal and Gav Cal, and myself wrote a number of pieces. Now, usually, I start off with the premise that what matters the most is the cost of capital and the cost of energy. When the cost of capital is low enough, and when capital is plentiful, and when energy prices are low enough and energy is plentiful, usually, the economy just moves forward because, every entrepreneur wakes up every morning trying to figure out how to make more money, how to produce more with less, etc. And that's what drives our capitalist system forward. which again, unless you have the breaks of too high a cost of capital, too high a cost of energy, that usually works. And that was part of the reason I was sort of dubious on the whole, we're heading into recession. Because in my career, most of the recession have been preceded by either massive price, big increase in the cost of capital, especially the cost of capital, I would say for the private sector more for the government, i.e. widening corporate spreads. And we didn't have that. And we also had a cheap price of energy. So I don't know, I felt pretty confident. But inherent in that belief is also kind of the hope that entrepreneurs wake up in the morning feeling good about the future, wanting to invest, wanting to move the ball forward. And this is where, the tariff throws an interesting wrench, because they add a lot of uncertainty. Now, the reality is most entrepreneurs just want certainty in their lives. They want to know what the tax rates are going to be. They want to know what the regulations are going to be, and then they get on with it. Now, of course, every entrepreneur wants a lower tax rate. Every entrepreneur wants lower regulation, but by and large, you deal with, you're told the rules of the game, and then you go out and play it, or not, or you decide, I don't want to play this game. I'm taking my ball and going home. My big fear when the tariffs hit, and I wrote it at the time, was that when you look at the construction sector in the United States, you're dealing with a bunch of entrepreneurs there who are still carrying the scars of 2020 and 21. In 2020 and 21, you had massive supply chain dislocations. You had bare shelves at Home Depot, lumber prices spiking, et cetera. And so a lot of projects got delayed, and delays in the construction industry means all of a sudden margins disappearing. And so my fear was that given these scars from the 2020, 2021 experience, a lot of the people in the construction industry, and I was seeing this talking to people, would react to the tariffs by saying, look, I don't know if in 3 months' time I'll get the pipes because the pipes are made in China. I don't know if I'll get the electric wire that's made in China. And the problem is if you don't get the electric wire, then it postpones everything, right? It's like if I can't get the electrician in today, then I can't get the plumber in the next day. And if I can't get the plumber, then I'm going to get the drywall guy in. And so everywhere around me, following the tariffs, I was hearing of, like projects being put on hold. Now, the reason this matters, now you could say, well, construction, it's only like 3-4% of US GDP, et cetera, but it's a huge employer. It's a massive, massive employer, which, by the way, that's another uncertainty is, am I going to, there's a lot of illegal workers in the construction industry, especially in the whole southern belt of the United States and Florida and elsewhere where construction has been absolutely booming for the past decade or so. Whether you look at your Arizonas, your Nevadas, your Texas, your Florida, this is where most of the construction was happening. So you're dealing with all of a sudden, if you're an entrepreneur, uncertainty of am I going to get the parts I need when I need them, at what price, and am I going to get the workers and at what price? Maybe it's just easier I hold back and not do anything. And I think what's interesting in the recent weak data that has come out is the extent to which it does seem to point towards weak construction. And again, like the PMI surveys that just came out yesterday were pointing like it disappointed, and it was all basically construction. So do I think we're going to have a US recession? It's a tough one because it's, if you look at typical models, cost of capital, budget deficits, cost of oil, you would say no. But so you almost have to make the argument that it's different this time. But if ever there's a time to make the argument that it's different this time, it probably is today, where policy making in the US is very different than, you and I have experienced through our careers. So it's hard to have a strong level of conviction either way. But I am fearful that the odds of recession are going up. Yes. I'm not like banging my fist on the desk saying, oh my God, to your listeners, watch out, US recession coming, et cetera. I'm not doing this, but I think we have to acknowledge that the odds are probably higher than we've seen since the post-COVID era.
Okay. And you're seeing that very much being driven by the construction side. Obviously,
yes.
Consumer spending has slowed as well. I mean, are there other dynamics at play? Obviously, with tariffs coming through, it's going to be a hit to disposable income in real terms. Any other channels you see kind of confirming the weakening economy scenario?
Yeah, look, I think all of these make sense. But again, for me, construction's a huge employer. Construction's also, there's a huge multiplier effect across communities everywhere. So I do worry about that. Yes, indeed. I think there is the squeeze on U.S. disposable incomes. And both from, inflation that is still there. I think, I can't remember the exact number, but I think inflation has been above the 2% mark of the Fed for something like 46 months in a row. Don't quote me on that exact number, but it's in that ballpark. It's essentially 4 years. The bottom line is, you look at consumer being squeezed, you look at construction being highly uncertain, and frankly, even capital spending in general. Like, if you look at the boom we've had in the US, it rested on many things. One of them of the recent years was capital spending in AI. Now, this might continue. However, what we're increasingly seeing is that the hoped for returns to the likes of Google and Microsoft and Apple, et cetera, and Facebook and others, the hope for returns aren't that great. So at some point, does the AI sort of rush ahead continue? We've had very, very strong consumer spending, which was partly linked to, I think, the wealth effect on houses, on equities, on crypto. Now, granted, you could say, well, equities are all-time highs, crypto are essentially at all-time highs, so maybe that continues. But maybe the lower-end guy does get squeezed. And then you had construction that was booming, and I think that part is slowing really hard.
Yeah, and I mean, obviously, when tariffs came along, there were a huge uncertainty, and that was the theme of Q1, Q2. I mean, it was reasonable to say, well, businesses will postpone spending decisions or investment decisions. We don't know what it's going to play out like. But now, I suppose you could say it is increasingly apparent what it is playing out. It's kind of 15% or 20% in most cases. Okay, we haven't got to deal with China yet, but the noises are positive. I mean, do you think as we get into Q3, Q4, we'll get to a point where there is certainty on the tariffs, albeit that they are now here at kind of elevated levels?
Yeah, look, I think there's really the three countries that matter the most for the U.S. is, what the U.S. trades the most with are Canada, Mexico, and China. Now, when it comes to Canada and Mexico, to your point, just like Europe, just like pretty much everybody out there, you're going to be in the 15 to 20 range. And I don't think that's inconsequential. That's a pretty high number. Somebody's going to have to pay for that. Now, I think that the premise that of the Trump administration is that either foreigners will pay or corporates will take the hit on their profit margins. Maybe they turn out to be right, but if the lower end consumer is made to carry some of that bag, then that bag's already pretty loaded. The low consumer is pretty stretched in the U.S. So you've got that, and then you indeed have the elephant in the room, which is China, which is right now at 50%. Now 50% essentially kills the trade. Now, China, unlike other countries, hasn't come groveling. And quite the contrary. They said, okay, we want to go down this path. We can raise tariffs on you. We can block the export of rare earths. We can block the export of magnets. We can bring your entire auto and armaments and aerospace industry to its knees in about 3 months. So, fine. Let's, you want to play, let's play. Bring it on. I think the perception in China is that, of course, this will hurt the Chinese economy, but that China's ability to withstand pain is much greater than the U.S.'s ability to withstand pain. That essentially, if the GM factories are shut for 2 weeks, then Trump will be seen as a failure. The whole Make America Great Again, American Industrial Renaissance, et cetera, doesn't work if Ford and GM can't get rare earths and magnets to make cars. So China has played that card. It's played it quite aggressively, which does probably open the door for a deal at some point. But it really seems like China's not rushing to get a deal.
So, I mean, what is a likely deal, would you say, given all of that?
So if you look at right now, China's at 50, 20 of which is the penalties for fentanyl. Now, already the U.S. is now going around saying, "Oh, there's been huge progress on fentanyl. It's now much better." So they can move pretty quickly from 50 down to 30. The U.S. can decide that unilaterally. Just say, "Okay, fentanyl, China's done tremendous work there. Well done. So we'll bring it back down." So they've given themselves this leeway with the fentanyl tariffs. By the way, tariffs that were also imposed on Mexico and Canada, and the U.S. said, "Okay, they're making progress, so we're taking that off." So, I suspect that's what will eventually happen. Now, once you get down to the 30%, after that, it's like, it's not obvious that it goes lower from here.
Yeah. So you think that it could settle somewhere around that kind of baseline, which would obviously still be significant.
I think 15 to 20 on everyone, and probably 30 on China is I think where we basically end up with the occasional other country that may also be at 30 or 35. But
to the question on impact on inflation, obviously it pushes up the price level. We've seen a little bit of that in the most recent inflation data on the goods side. That's been offset by weakness, I think, on the services side. Do you think we'll see more? And then where do you stand on, will it be more persistent over time? Like Chris Waller seems very intent on the view that it's a one-off price impact and it's not going to lead to sustained inflation. Would you be as confident on that view?
I hate to make like a Jesuit priest and answer your question with another question, but I think that the answer to your question depends a lot on what your outlook on energy is and what your outlook for the U.S. labor force is. Because the reality is that goods, within the U.S., like goods inflation is only a fraction. What probably really matters is whether we start to see wages push higher. Now, historically, a huge catalyst for wages pushing higher is higher energy prices. Somehow, there's a psychological element to energy prices. Perhaps because when we drive to work, we see the gas price on the side of the road. Perhaps because it's the one thing we buy consistently, and it's always the same thing. I fill up my car every week, and I know I pay X to fill up my car, and so right now energy prices are low, gasoline prices are low. And so, wages are still not really rising all that fast, even with the immigration crackdown. Wages haven't been shooting up. Now, fast forward 6 or 12 months from now, if energy prices have moved up, and at the same time you've got a tight labor market because you've kicked off all the illegal immigrants, then you really have the recipe for, I think, an inflationary spiral where wages go up, at the same time good prices are going up, and gasoline prices are going up, and then the narrative, the popular mood really starts to swing to, oh my God, there's so much inflation. So energy prices at this juncture are really, really critical. And I would say that if energy prices start to rise, then probably President Trump's presidency starts to become very challenging. As long as energy prices stay low, basically the show more or less may manage to stay on the road. So I hate to hate. Now, I happen to be a bull on energy, so I happen to be an inflationista. But I willingly acknowledge that energy prices today are low, and that we're going through an interesting time in energy, because on the one hand, I think we've underinvested in carbon for 10 years now, and the scope for oil and natural gas, et cetera, to go up is there. But at the same time, you have the biggest energy importer in the world, namely China, that has invested like absolute crazy in its ability to deliver electricity and to essentially fund its own transition from carbon-based energy to electricity, whether that electricity is produced by nuclear, by solar, by LNG plants, by hydro, by coal-based fire plants. But China now produces twice the amount of electricity that the United States does. So which is funny, because the U.S. is still supposed to be at least a third bigger as an economy. But when you look at electricity production, and if you think that's probably a decent proxy for the size of an economy, China is now twice the size of the United States. So all this to say, we're at an interesting point where, the energy of the future is electricity. It's not gasoline. It's not diesel. The energy of the future is electricity. China is moving very rapidly in that direction. The rest of the world, not as much. But meanwhile, we've also massively underinvested in carbon. So depending on where you fall on the energy question, I think will dictate how you fall on the inflation question. So I'm a bull on energy. I think energy prices move higher. I think inflation thus moves higher.
And what's the bull? I mean, I get the underinvestment case in energy. Obviously, oil prices have been stuck here in a range for quite a while now. And obviously, we've had geopolitical events, we've had Iran strikes, etc. And, the view always seems to be, you get a spike, it's a good opportunity to sell because the market's quite well supplied at the moment. So what changes on that front, or what are the risk factors, do you think?
Yeah, look, I think the main thing is big energy bull markets are driven more often than not by demand. And so I think what changes, what people underestimate is, you could look at energy essentially, you've got different billion people markets. So China's a 1 billion person market. Like I'm rounding, of course, it's like 1.3, but let's just call it 1 billion. India's 1 billion. Africa will very soon be 1 billion. And then the developed markets are essentially 1 billion. And then everybody else is 1 billion. If I'm going to make it like very, very simplistic. So Africa has been a huge net energy exporter. That probably changes in about 3 or 4 years as between their population growth and their standard of living growth. So they switch from being an exporter to an importer. India continues to import more and more. So I think people focus on China because it's been the big story of the past 3 decades in energy. And then they say, oh, look, China's energy needs are plateauing. They're importing less, or they're importing as much. They're no longer growing. But it's missing the story that's occurring elsewhere in emerging markets. So when you look at total oil demand, it's still growing by 1 million to 1.5 million barrels per day every year, ballpark. So for that, given, the fact that, wells lose capacity over time, to make that extra 1.5 million barrels, you need to continuously invest. Now, today you could say, yeah, but you know what? OPEC probably has 2 million surplus. Yeah. And that probably covers you for the next year. And then what? So then what you could say, well, you got some coming out in Suriname and some coming out in, but here's a fun fact on the other side. From nowhere 5 years ago, China is now the biggest car exporter in the world. Like that, something that nobody expected. Like China is now the biggest car exporter in the world. And 85% of the cars that China exports, and on any given month, 80 to 85% are ICE cars. Like the electric cars stay at home and the ICE cars go abroad. Why? Because the cars go to emerging markets. And when you live in Colombia, when you live in Indonesia, your electricity grid isn't going to support electric cars. Also, electric cars depreciate too fast for emerging market investors. Good thing about ICE cars is they last 20 years if you take care of them. So now all of a sudden, what you have in Indonesia, in Vietnam, in Colombia, in Brazil, you have people who buy cars who never bought cars before because they're buying Chinese cars for less than $10,000 a car. So you have all of a sudden people driving ICE cars all across the global south that were not consuming gasoline up until 5 minutes ago. And I think that's the part that perhaps people are missing today is, yes, on the one hand, OPEC's got this extra 2 million, et cetera. But at the pace at which China is exporting cars, you're going to need gasoline. You're going to need more refineries. Nobody's building refineries. You're going to need more refineries, et cetera. And so I do tend to think that the risk is to the upside.
That sounds like maybe a story for next year or the year after, and not necessarily for the next 6 months.
These things are always so hard to tell, right? What I do know is that today's equilibrium is unstable. Now, you're absolutely right that it could be stable for the next 6 months, 12 months, 18 months, absolutely. But I think that if there is a risk to our system today, if there is a risk to global economic growth, if there's a risk to we're now set on an easing stage for central banks everywhere around the world, whether, the Fed that's going to be easing, the ECB that's easing, EM central banks everywhere easing, etc. If there's a risk to this whole environment, it is that oil prices spike. Now, granted, I take your point. It's like, yeah, but that's not going to happen in the next 6 months. Probably like 90% chance it doesn't happen in the next 6 months. But what if it does? What if in that 10% chance it does? Then it's going to obliterate your portfolio. So at the very least, you don't invest on the premise that this is going to happen, but you buy protection for your portfolio in case it does.
You mentioned easing likely for the Fed. I mean, do you think now the Fed's going to come under so much pressure that it will cut in September, and how much between now and the end of the year?
Yeah, I think it cuts in September. Unless, again, I'm sounding like a Jesuit priest, like hedging everywhere. But there's 2 CPI prints between now and September, unless you get 2 bad CPI prints. And by bad, I mean the CPI that surprises on the upside, that it turns out to be much stronger than expected. Unless you get that, I think you're getting those job numbers we just had, almost guaranteed that you're getting a cuts in September. Now, beyond that, is it going to be 25? Is it going to be 50? I think a lot of that will be driven by the data between now and then. But recent PMI, recent ISM have looked softer. Like if all these things continue, then yeah, probably 50.
Okay,
and then that allows the Fed to sort of at least get Donald Trump off their back a little bit.
Speaking of which, the big topic in respect to the Fed is what happens next. So obviously it seems like Trump isn't going to fire Powell just yet, but obviously the window for putting a replacement in is opening. Obviously there's a spot for a new governor, and then which may or may not be the person who becomes the chair. What's your thinking on this? Obviously it's kind of 2 Kevins and Chris Waller are probably the 3 names. I know there's a 4th. I'm not sure if that's Bessent, who's now seems to be ruled out, or if there is somebody else. But back to the betting markets, they're the top 3 contenders. So
I thought Trump wanted to appoint himself.
Well, that was also mooted at one point. Yeah, not impossible, but yeah.
So first, I don't think he fires Powell. I don't think he fires Powell because Powell at this stage, he's set him up as the perfect scapegoat. He's done these big tariffs, which may or may not work. It's a big gamble. If it pushes the U.S. into recession, he can turn around and say it's the Fed's fault. It's Powell's fault. I've told you all along, this guy's an incompetent, et cetera, et cetera. So he set up Powell as the scapegoat. So why would he want to get rid of him? Like as soon as he gets rid of him and puts in the other guy, then he owns the economic situation, either guy or girl. He owns the economic situation. So I think Powell essentially serves out his term because he serves a purpose now, which is the being a scapegoat. Beyond that, who he picks, I think at this stage, what really matters more is that, it's been signaled, it's been telegraphed that the Fed from here on out will be following easier monetary policies, and will be essentially pushing the U.S. towards a weaker dollar. And, I would say who cares about the personalities at the top? What matters for us as investors is the highest odds are that we're going to have a set of policies that almost guarantee steeper yield curves and a weaker dollar. So that's what matters to us. And a steeper yield curve, a weaker dollar, that usually means outperformance of financials, which is what you're seeing in markets everywhere. It usually means outperformance of emerging markets, which is what you're increasingly seeing. Usually it means the outperformance of value against growth, which we're not really seeing yet. But I think we'll see, probably further down the road.
Plausible. I mean, the one thing I would say is like the likes of Kevin Warsh has very distinct views on, balance sheet normalization and been very critical of the Fed's approach around QE. So, I mean, if we saw him come in, obviously he's in favor of rate cuts at the moment, but he does seem to be a bit more of independently minded than maybe say Kevin Hassett.
That's a very fair point. I'm a big believer and a big proponent. I always say that, look, as money managers, we're paid to adapt, not to forecast. So I'll be dead honest with you. I'm not actually spending that much time thinking through all the various scenarios of, once who gets it and what they do once they get it, etc. Because like once we know who it is, then I'll start thinking, okay, so if it's this guy, so it probably means this, this, and that. Having said that, people change their minds, people evolve as well. But it's like I fear that trying to anticipate the various guys' moves is maybe too many chess moves ahead. I played a fair amount of chess in my youth, and I was never very good because I could never do more than sort of 3 moves ahead. Like, the really good guys go like 6 moves ahead. I could do about 3 moves ahead in my head, and then I'd sort of lose it. And as an investor, I try to do the same. I try not to be too many moves ahead because it just the complications just get too big.
Fair enough. You did mention a weaker dollar, and this has been a theme this year. Obviously, the dollar's had, I think it's like the worst start measured on a calendar year basis, or at least it did going back a few weeks. And the narrative was all about kind of outflows. The end of US exceptionalism obviously was one narrative, which has kind of diminished a little bit as the equity market has come back, and then outflows from the US market, and obviously some hedging pressures as well, undermining the dollar. So putting all of that together, and obviously, in the background, chatter about, US reserve status under pressure as well. I suppose that's the consensus view. Hard to disagree with it. What do you think?
Yeah, I think it's hard to disagree with it. I think we are seeing a paradigm shift in the US dollar. And look, perhaps the most important shift in the US dollar, if you were a French pension fund or a Korean insurance company, for years, you bought US equities and you were long the US dollar. And if ever there was a market accident and equities went down 10%, typically your own currency went down 5%. So net on your US equity position, you would be down 5%. So it was, nobody likes being down 5%, but it's not the end of the world. So the fact that for years and years, the US dollar was this port in the storm, this shelter in rough seas, made US assets very attractive and made the US dollar very attractive, and a sort of very reflexive move for foreign investors. And I think this was shattered this year. We saw it very well in April when the Liberation Day tariffs were announced. Instead of going up, the US dollar went down. In fact, for a period of about 8 days, you had the bond market in the US, the equities, and the currency all falling at once. And if you've ever done the emerging markets, you recognize that pattern immediately. You recognize that pattern, you're like, okay, I've seen this movie before. This is an EM crisis. I'm out of here. When you see those 3 things fall together, it's usually it's a big warning bell. And that's why I think Bessent and Lutnick had to intervene, and they talked the tariffs back and stabilized the markets. But the message was nonetheless sent that from now on, when US equities fall, so does the dollar. And therefore, this makes US assets, just this shift in correlations, makes US assets a lot less attractive to most institutional investors everywhere. So I think that's, you got that. Of course, you've got the greater uncertainty around politics and policies in the US. And politically, it's now no longer good to be seen being overweight the US if you're running a public pension fund in Holland or you're running a sovereign wealth fund in Singapore. Like, being massively overweight the US may not be the smart trade. So bottom line, I think the default mode amongst large institutional investors is now to bring money home. For the default mode for 15 years was I invest in the US. Now the default mode is bringing money home. But the problem when you talk to pension funds in Germany or pension funds in Canada, they always tell you the same story is, I want to bring money home, but I don't have any assets to buy at home. Now, this is where it gets interesting, is if you look at the new chancellor in Germany, at the new prime minister in Canada, the new prime minister in Canada, comes out of Goldman. I tend to believe that you can get the guy out of Goldman, you're not going to get Goldman out of the guy. So if you now have pension funds that come to see him and say, hey, Prime Minister Carney, give us assets to buy, he's going to say, all right, I know how to do this. Let's build some infrastructure bonds. Let's IPO the airports. Let's build pipelines into British Columbia to sell the oil to Asia, and give all these Canadian pension funds that have hundreds of billions invested in the US opportunities to bring money home. And I don't want to pick on Mark Carney, because you take the German chancellor, he used to be the CEO of BlackRock for Europe for 6 years. So how hard is it for him to structure infrastructure bonds and call the head of every pension fund in Europe that he knows on a first name basis? Probably not very challenging. So I do think this trend is starting, where the marginal dollar, instead of being invested back into the US, is now increasingly going to be invested domestically.
Makes sense, I guess. I mean, the one thing that it ignores is the AI theme, and the Mag 7 have come back, having been under pressure for a while. So if investors want to play that theme, that obviously the US still remains the obvious place to go to. I mean, you mentioned that maybe some questions around the return on investment, but at the same time, recent results from Meta were encouraging, and I think the likes of Microsoft and a number of them were announcing upgrades to their CapEx spend. So, I mean, for the moment, it still seems to be raging on. Is that not part of the picture, or you're a bit of a skeptic?
That's a massive part of the picture. That's a massive part of the picture, because you're absolutely right to highlight it, in that you've had an epic capital spending boom in the US, where I actually recently wrote a piece on this, where CapEx in the US over the past few years has gone from 9% of GDP to 11% of GDP. And this 2% of GDP increase in CapEx, by the way, historically, it tops out at around 11.5%. Like in 2000, it topped out at 11.5%. That extra 2% has really gone to a handful of companies, because that increase in CapEx, some of it has been in data centers, some of it has been in building out new power plants, although nowhere near enough. And most of it has been in AI. That 2%, it's gone basically straight into NVIDIA's bottom line. Exaggerating, of course, but don't send me data saying it didn't all go into but it's gone into NVIDIA, and yes, to Microsoft. And so the question now becomes, you've had this huge increase in CapEx. What do we get on the other side of it? Now, do we get the productivity gains, and do we get the profits that flow to these businesses that have essentially turned themselves? You take a Facebook, it's essentially turned itself from an extremely asset-light business into an increasingly asset-heavy business. Now, again, if the money flows in, then happy days. Then the show stays on the road. And yes, people want to keep buying Facebook, and they'll want to keep NVIDIA, etc. If the returns don't come through, if AI turns out to be very commoditized, and if the profits on there, or the productivity gains, aren't what was hoped and expected, then the US really hits the wall really, really, really hard. Because right now, what is keeping the show on the road, to your point, is this excitement around AI. Take that away, and all of a sudden, things start to look pretty dire.
And what's your thoughts on in the next downturn? I mean, there is a view that because now of increased usage of AI, LLM, etc., that a lot of those entry-level positions are not being filled, and that in the next downturn we could see even more adoption, and corporates trying to squeeze as much out of AI as they can, and much higher unemployment. Is that too early to expect that, or is that a risk factor on your radar?
No, I think you have to worry about that. I mean, look, that's the very linchpin of the AI hope, is the idea that we're going to get this productivity gains.
That's the productivity gain, isn't it? Yeah,
it is. So it's you have to worry about it, because either there's two options. This is going to be real, and where all this, to your point, the entry level jobs in insurance companies and in banks and in a lot of places are going to disappear. And so then you have to wonder, okay, so what does that mean for our societies? What does that mean for jobs in general, et cetera? So that's your one path. And the other path is, like I said, I think it turns out to be a dud, nowhere near as productive as we'd hoped. And we have a hell of a stock market correction. It almost reminds me of that Woody Allen quote, right? About how, we've reached a fork in the road. On one side lies despair, and the other lies, misery, and that I hope we choose wisely. So I don't want to sound depressing for your listeners. I tend to believe, and I may be wrong, but from my own playing with it, I tend to believe that the level of hype on AI is off the charts, and that there will be some productivity gains, sure, but it'll be nowhere near what we're being told, and it won't be near enough to justify either the levels of capex that have been put into this thing, or the levels of the valuations on a lot of assets. I mean, I'll give you just two examples, right? If you go back to 2008, in 2008, the whole world from peak to trough lost 18 trillion in equity market cap, right? So you had essentially 500 billion of losses on mortgage bonds that triggered 18 trillion of market cap equity losses. It was a bloodbath, 18 trillion. Now, okay, keep that number in mind for just a second. Today, if you look at NVIDIA plus crypto, just those two assets, NVIDIA and crypto, they're today together, it's more than an $8 trillion market cap, right? Now, crypto and NVIDIA just 2 years ago, were 2 trillion market cap. So they've gained 6 trillion in market cap in 2 years. Now, 6 trillion is a lot of money. There's I think there's only two economies in the world that have more than a 6 trillion GDP. They're China and the US. So 6 trillion is a huge amount of money. And that's what's been gained in just 2 years by those two asset classes. Now, when you look at NVIDIA and when you look at crypto, these are asset classes that every 3 to 4 years lose 75% of their assets. That's just what they do. I mean, it doesn't mean they're bad. I'm not putting a value judgment on it. I'm just saying, like, look, these are these have asset classes that through history have had massive volatility and massive upside and downside volatility. Now, you could say, well, this has changed now, that's over. But let's imagine that it hasn't changed, that, at some time in the near future, we got a 75% wipeout on these guys. That will be 6 trillion that will pop away like this. That's a third of the equity loss of 2008 in just two asset classes. Now, imagine the impact this will have then on capital spending, this impact this will have on consumption. There'll be a lot less boats being sold, and a lot less sports cars and whatever else. So, for me, this is now the big risk in the market, to be honest, is we've reached a point where the hype on AI, the results really have to be pretty outstanding to match the level of hype that was put in.
You mentioned earlier about the period in April with the dollar bonds and equity selling off at the same time. And, it brought into, I suppose, focus the kind of maybe structural concerns about the long end of the curve in the US. You mentioned the likelihood of steepening. But we've had the big, beautiful bill. Deficits are not getting any smaller. They're getting larger. And on a trend basis year on year, we've just got used to kind of 6, 7, 8% of GDP. But we're not seeing a huge reaction from the bond market. Obviously, yields went up to maybe 4.6%, or back to 4.25% now. There was a view in the markets, do deficits matter? I mean, at what point do they matter?
It's the old story, right? It's like tequila shots. You've never known when you've had enough until you've had too much. And government debt tends to be the same story. You feel good, and then at some point you're throwing up in the bathroom. So yeah, your point is, when do we start throwing up in the bathroom? And the answer is, I'm not quite sure, but I know it's not a great asset class to own, because at this pace, it's like you're seeing the guy at the bar just pounding the tequila shots, and there's nothing good coming out of that. You're not quite sure when he's going to hit the wall, but that wall is there. Yeah, so I do look at the fiscal situation across most of the OECD, and the reality is, you could say, oh, it's bad everywhere, etc. But there's really 3 countries that have really bad fiscal situations today. One of them is my own of France. The other is the UK, and the third is the United States. These are really the 3 countries where, when you look at the increase in debt, you can start getting worried. Now, the UK and the US still control their central bank, so they have the option to monetize the debt, to essentially take the pain through currency devaluation. through currency devaluations and a weaker currency. It's harder for France to do this because we're obviously part of the euro. And so, if you want to look for a debt crisis, perhaps the more obvious candidate at this juncture has to be France, where you have a very tenuous political situation. You have a government that can't pass a budget, that's coming back in September from holiday, doesn't control parliament because parliament is divided a third, and every one of those three groups hate the other two. Where basically building coalitions is impossible. And then you could say, well, if France hits the wall, then maybe that gives another boost to U.S. Treasuries, where foreign investors say, Europe, it's screwed. These guys can't fight their way out of a wet paper bag. I thought they had it together, but they don't. By the way, I'm not saying this is going to happen, but I think that the risk of that is not zero. And then, money comes back into U.S. Treasuries. So, you can actually make a bull case for U.S. Treasuries. Personally, I don't own any U.S. Treasuries. I think the U.S. dollar is a structurally weak currency from here on out. I personally have no interest in owning bonds in currencies that depreciate. I like to own bonds in currencies that appreciate. Currencies are bound to be strong. I have no interest in owning U.S. Treasuries, but you could see an argument where, okay, actually, out of the three weak links in the system, France is the weakest link, and when it breaks, it'll boost the U.S.
And what's the scenario for French problem? Obviously, in Europe, we've had easing from the ECB, so they've been much more ahead of the curve, I guess, and the Fed has been. Obviously, as you say, in Germany, we've had the debt brake being loosened. So.
Yeah. Maybe it doesn't, which is why I said I'm not sure we go this way.
Shifting gears, I mean, last time you were on was kind of, I think, October last year. It was not long after the big kind of China announcement, the stimulus at that point. It was a kind of a big spike in the equity market. It's been kind of up and down since then, but probably a little bit higher. So, it hasn't reversed. But you mentioned the kind of the China now the exporter, the largest exporter of cars in the world. And that's been the Chinese strategy, isn't it? Flood the world with its excess manufacturing capacity. To date, I guess countries like Indonesia, as you say, Brazil, have been happy to absorb that excess capacity. I mean, where do you see China now in its process of coming out of that big deleveraging that it's been going through for the last number of years?
Yeah, so I'm not sure that it's been China's strategy to flood these other countries. I think China's strategy is actually a bit different. The way I conceptualize China is that China was humming along, and in 2018, the US embargo on semiconductors was a massive shock to the system. That when the US said no more high-end semiconductors to China, essentially the Chinese leaders panicked. They thought, okay, if they're blocking us from semiconductors today, tomorrow it could be auto parts, it could be tires, it could be chemical products, it could be anything. The US is trying to trip us up economically. We thus have to become self-sufficient and independent, resilient on every single supply chain. And so in 2018, essentially the government tells the banks, guys, normal loans to real estate, normal loans to the consumer, all the money has to go to industry. And so we go through 7 years of all the loans. Like if you were an auto manufacturer, you'd get a loan. If you were a battery manufacturer, a chemical producer, like whatever, you were getting a loan. If you wanted, but real estate, forget about it. And so you see real estate loans absolutely collapse, and you get a epic real estate bust, unsurprisingly. Imagine if tomorrow the Irish government told the banks, you're not allowed to lend to real estate anymore. What that would do to the real estate market? Probably nothing good, especially if valuations were stretched to begin with. And then you also had fairly little consumption because you lived through it in Ireland. When people's real estate goes down, you tighten the belt, and it's not like you go out to the movies or the restaurant. So that was the story really of the past 6-7 years. And while this happened, it did create all this excess capacity that you talk about. And so now, today, China turns around and produces all these cars, all these tractors, these telecom switches, these railroads. And then indeed, the question becomes, okay, where are we going to sell all this stuff? Now, the obvious market would be obviously the developed markets, but there's protectionism against China. And frankly, the Russia invasion of Ukraine And the fact that China has sided with Russia has made all that part, even more complicated. And the Western world is even less likely to do business with China. So then the only market becomes this global South, for lack of a better word. It becomes Latin America, Middle East, Southeast Asia, Central Asia. But all these countries are poor countries, so China's got to provide funding. And this is where we are today. It's like, okay, China's now starting to export these cars, these train systems, etc. In what currency are we going to fund this? And this is where it gets interesting is, if you go back to 10 years ago, 5 years ago, all China talked about was funding its trade in its own currency, in the renminbi. And it talked about the offshore renminbi. And what China was saying was essentially, look, Indonesia will buy your coal for renminbi. And if you don't want to keep the renminbi for, whatever reasons that are yours, you can come to Shanghai and exchange your renminbi for gold. And now what they've realized is that the more they trade and the more they push out the renminbi, the more people buy gold on the other side. And so gold starts to go, not yet, but starts to move parabolic. It starts to move up. Now, the risk now, if you're Chinese, if you're the Chinese central bank, if you're the PBOC, the risk is that gold really, really starts to shoot up, because Chinese investors themselves, first, love gold. Secondly, love a momentum trade. They're the biggest momentum investors. So if gold starts shooting up, then they all start buying gold. And the risk then is that gold goes absolutely bananas, and then it crashes, and you've wiped out an entire generation worth of savings, and you've made people very angry in the process, and you've destabilized social peace. So you will have witnessed perhaps that in the past sort of year, there's been a big change of rhetoric from the PBOC, and I've written a number of pieces on this. But the rhetoric is essentially the PBOC now comes out and says, you know what? China's unique because we have two currencies. We have the renminbi and we have the Hong Kong dollar. Now, we can use the renminbi to fund our internal trade, and we can use the Hong Kong dollar to fund the external trade. But of course, if we're going to fund all this trade in Hong Kong dollar, then we're going to end up with a lot of excess liquidity in Hong Kong dollars. All this Hong Kong dollars that get created, pushed out into the system, eventually come back into Hong Kong banks, buy Hong Kong assets. So I think we've started this cycle. Last year, the Chinese equity markets were actually the one market that outperformed the US equity market. This year, again, Hong Kong is massively outperforming. And nobody cares. Nobody cares. I look at China. When I look at any market, I look at it through 5 prisms. First, I start with fundamentals. Does it make sense? And I would say China today, they put down more patents than any other country. They've gone from graduating 1 million university students a year to 13 million university students a year. They've spent the past 20 or 30 years dramatically improving their infrastructure to the point where they now have the cheapest electricity costs in the world. They have the cheapest transportation costs in the world. So the fundamentals actually make sense. Then I look at valuations. They're still very attractive. The momentum is now very solid. Then you look at investor positioning, and nobody owns China because, remember, they're always about to invade Taiwan and all sorts of crazy stuff. And then finally, you look at policy support, and this is where you've had the biggest shift in China, is that up until a year and a half ago, the rhetoric from the Chinese government was put all the money in building industry. And now the rhetoric is we want asset prices to go up. And we want to create a positive balance sheet effect, partly to boost domestic consumption. So yeah, I think, look, we've started an equity bull market in China, and frankly, nobody's involved.
So the transmission mechanism and the Hong Kong dollars are linked to kind of emerging markets who then sell those back into the system in Hong Kong. So you got more liquidity in the system there that flows into the equity market, and
you see the success.
There, basically.
You see the success liquidity. One of the things that's been a head scratcher for many investors is the extent to which Hong Kong interest rates. So Hong Kong is pegged to the US dollar. For your listeners who don't know this, the Hong Kong dollar is pegged to the US dollar. So historically, the interest rates are roughly the same because otherwise there's always an arbitrage opportunity, right? If I can borrow Hong Kong dollars, that's pegged to the US dollar. And now at periods of crises, what would usually happen when people worry, oh my God, the peg's going to break or whatever else, at periods of crises, Hong Kong dollar interest rates would move far above US interest rates to essentially attract people back into the Hong Kong dollar. This is how the peg works. All year long, you would have seen that HIBOR rates are like way, way below US interest rates. Not by a little, but by like 200 basis points, which is frankly unprecedented. And is a testimony to all this excess liquidity that is now sort of flowing into the Hong Kong dollar in sort of broader world.
Do the Hong Kong banks not just buy the dollars, and is there an arbitrage there that somebody has got on huge scale?
No, I think the Hong Kong banks do it, but they've got so many deposits in Hong Kong dollars coming in. They don't know what to do with the Hong Kong dollars.
Yeah. Okay. Just conscious of time, outside of Hong Kong, well, which is not really emerging, I guess, but emerging markets more broadly, I mean, you painted a positive picture from the perspective of, an environment of, a weaker dollar, which would generally be positive for global liquidity and for EM. I mean, from a more kind of structural growth perspective, how do you see, how has EM been playing out? Obviously, the tariffs, I guess, are a headwind for certain countries. Or not, or how do you see that?
Yeah, I think look, to the extent that everybody's getting them, it sort of evens out.
It evens out. It's like,
now you've had some that have been punished more than others. Brazil's the obvious one. Now, I happen to have been and remained a bull on Brazil. I look, and for that matter, the whole broader Latin America spectrum. Today, especially if you're a fixed income investor, it's the one part of the world where you can easily anticipate 150, 250, 350 basis points of interest rates drop over the next 18 months. Like today you can go out and buy a Brazilian TIPS giving you 7.5%, 8% real returns. You can go out and buy Brazilian bonds that are going to give you 14% nominal at a time when inflation is roughly 5.5. So nowhere in the world has that level of real rates. And in a weaker dollar world, the local central banks will have their hands free to cut interest rates much more aggressively. So I think there's tremendous trades to be had in Latin America. I think the Chinese equity market has started a bull market that few people are even noticing. So yeah, there's things to do out there.
So is that your top tip for the coming year, months? I mean, is that what your most high conviction view, bullish EM, or what would you say?
Oh yeah, my highest conviction move, believe by far, is we're starting a new bull market in emerging markets. A bull market that won't be derailed until we either get a new Fed tightening cycle, which seems highly unlikely right now, where we're going quite the opposite, or until we get much higher energy prices. And again, as you pointed out, right now things are stable. It doesn't seem like a spike is the most likely scenario for the next 6 to 9 months. So now I want to buy hedges against that spike because I'm super long emerging markets, and I do worry that they would get squeezed if energy prices shot up. So I want to buy hedges against energy prices shooting up, but to protect my EM positions. But EM is where you want to be.
Good stuff. Well, great to have you back on again. I'm sure we'll do it again maybe next year or at some point and reassess all of those calls. But for all of our listeners, obviously keep tuned and make sure to follow Louis' work at Gavical to get his insights over time. But from all of us here, thanks for tuning in, and we'll be back soon with more content.
Thanks so much, Alan.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.